If you've ever felt like investing is 1,000 random tips and no plan, this video is your reset. I'm going to give you a simple, durable process to invest the right way. One you can write on a single page and actually follow. No hot picks, no crystal ball. Just a plan that survives real life. Step 1 is foundation. Before you invest, clear anything charging double-digit interest, credit cards, buy now, pay later, high-rate personal loans. The math is brutal. A guaranteed 20% interest charge will outrun almost any portfolio. Then build an emergency fund, 1 month of expenses to start, aiming for 3 to 6 months over time. This isn't glamorous, but it stops you from selling investments at the worst possible moment. Step 2 is purpose. Money with no job misbehaves. Name your goals and horizons. Under 5 years. Think defense, cash, and short-term treasuries. 5 to 10 years? A balanced mix. 10 years plus? You can lean into stocks because time smooths volatility. Write the goal, the horizon, and the amount required. When markets get loud, that sentence keeps you from making a headline-based decision. Step 3 is account choice. Use the tax wrappers you have access to. Workplace plans like a 401k or similar. Grab the employer match. Free money beats everything. Then look at an IRA or ISA, depending on where you live. Tax-efficient accounts don't make you smarter. They make your compounding less leaky. Fees and taxes are the 2 drags you can control on day 1. Step 4 is asset allocation, the split between stocks and bonds. Here, S a sane starting point. If your horizon is 10 years or more and you can handle big swings without panicking, 80% stocks and 20% bonds is a strong default. If you're more conservative, 60-40 still works. The precise number matters less than your ability to stick with it when the market tests you. Your allocation is the shock absorber. Choose it around your stomach, not your ego. Step 5 is instruments, the actual things you buy. Keep it boring. Broad, low-cost index funds, one for stocks, one for bonds. If you want US exposure, a total market or S&P 500 fund plus a high-quality bond fund does the job. Want the whole world? Use a global stock fund and a global bond fund. The rule is simple. Microscopic fees, clear index, low turnover. You don't need style boxes, factor acronyms, or 12 overlapping funds. Depth of conviction beats breadth of clutter. Step 6 is automation. Set a contribution that happens the day after payday and forget the calendar. Dollar cost averaging isn't magic, it's discipline. It stops you from waiting for the dip and missing entire years. Reinvest dividends. Give your portfolio the boredom it deserves. Step 7 is maintenance. Once or twice a year, no more, rebalance back to your target mix. If stocks ran hot and you're at 87-13 when you meant to be 80-20, sell a bit of stocks or direct new contributions to bonds until you're back in range. Rebalancing is the unemotional act of buying what got cheaper and trimming what stretched without turning you into a day trader. Let's make this real with numbers. Suppose you invest $300 a month at an average 8% over 30 years. Now the part almost no one tells you. Your behavior matters more than your spreadsheet. Write a short investment policy statement. 1 page, plain words. Mine looks like this. What I own, why I own it, how much of each, when I add money, when I rebalance, and under what conditions I'm allowed to change the plan. I also include a do-nothing checklist for bear markets. Have I touched my emergency fund? Has my horizon changed? Is my allocation still appropriate? If nothing has changed except prices, I do nothing. That single habit has saved more portfolios than any clever trade. Common mistakes and how to avoid them. Chasing performance, buying last year S winner, usually means you can relate to a party that S already winding down. Fix it by setting rules once and rebalancing on a schedule. Over-diversification is another one, owning 15 funds that secretly own the same stocks. Clean it up. 1 broad stock fund, 1 broad bond fund, done. Paying high fees because the fund looks smart? Remember this, you don't need to beat the market to win at investing. You just need the market's return minus microscopic costs over a long time. That's a surprisingly high bar for most people to clear, and it's completely available to you. Questions I get every week. Should I wait for a crash? No, you can't compound on money that isn't invested. If you're nervous, split a lump sum into 4 or 6 monthly chunks, but set the schedule and stick to it. Should I add international stocks? Reasonable people disagree. I like global exposure, so I don't have to predict where the next decade's winners will live. Should I tilt to small caps, value, or dividends? You can, but only if it doesn't tempt you to change your plan every time the tilt underperforms. The perfect portfolio is the one you'll keep funding. What about risk? Risk is not the line on a chart going up and down. It's the chance you won't reach your goal on time. Reduce that risk by matching your allocation to your horizon, keeping costs low, and avoiding forced selling. If you need money in 3 years for a down payment, that money is not a stock market bet. Put it somewhere boring and safe and be glad it's boring. Here's a 5-minute setup you can do today. Log into your workplace plan and push contributions up to the match. Open the best low-cost account available for your next dollar, IRA, ISA, or taxable brokerage if you've maxed the tax-advantaged options. Pick 2 funds, a broad stock index and a broad bond index. Set an automatic monthly amount you know you can keep through good months and bad. Turn on dividend reinvestment. Put a calendar reminder for a single rebalance date each year. Then close the tab and go live your life. If you want to refine from there, do it once a year. Maybe you edge from 80-20 to 70-30 as your target date gets closer. Maybe you add a small satellite position you enjoy researching, 5% or less, to scratch the curiosity itch without risking your core. Maybe you raise contributions a little every time you get a raise. Iteration beats reinvention. Let me end with a story I've seen for over a decade. 2 colleagues start on the same day. One hunts for the perfect stock, switches strategies every quarter, and reads market news like it's a weather report. The other sets up an automatic contribution into 2 low-cost funds and forgets about them. 10 years later, the headlines are forgotten, but the contributions are still there. Quiet, relentless, bigger than they looked at first. The difference isn't luck. It's the compounding that flows to the patient. Investing done right is not a talent show. It's a systems game. Rules you can follow, costs you can control, time you can stay invested. Build the foundation, pick your allocation, buy the market cheaply, automate the habit, rebalance calmly, and let arithmetic do the heavy lifting. That's how you invest the right way. And if you want step-by-step help choosing funds and avoiding hidden fees, watch the 2 videos linked at the end screen. Those will plug straight into this plan.